Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, March the 26th. I'm Eric Wilkinson, and you very well may recognize me from mainstream media, where I've talked about the economic, geopolitical, and market analysis based on those assumptions. I do the same thing in these daily market commentaries, but I'm layering on top of it option strategies that we can implement into any portfolio in order to increase our yield and probabilities of success. No better points being made than today. Back in black is what I've been talking about because my portfolio has gone back into the black. Now, if you were buying at all-time highs, well, I've showed you in my webinars right now, implementation of options into your portfolios, how we can take advantage of options in this type of environment. And dollar cost averaging, all of those things have been working out. So I hope you guys have been paying attention to those. If not, please go to Pro Trader Strategies and check those out. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with the economic data from across the pond. We got German customer climate came in at 2.7. Expected to be 7.4, and the previous month revised down by a 1.5 as well. So not really anything unexpected, as we would know that coronavirus was starting to seep into mainstream media at this time. These were all coming out. We also got Great Britain retail sales coming in at negative 0.3%, expected to be a positive 0.2%. Back here in the United States, the only thing that I really want to talk about is because GDP, and we did get GDP and natural gas storages, which were in line with expectations. Wholesale inventories was a better draw than what was expected. But one thing we do want to note here is this number, the unemployment claims, 3.283 million. That says 1,000, but it's 320 or 3,283,000, which makes it 3.283 million unemployment claims. That is huge, twice as many as what was expected, you guys. That is just astronomical, and normally we would be used to seeing 300,000. We saw 3 million, and I just wanted to throw up this chart here because what we're looking at is basically a 7-year chart here, and as you can see with this line in the sand that we're looking at, right here is right around that 300 mark. You can see it's basically below 500. And this is where we're talking about on the line here with 3 million. All right, 3.283 million. So it just completely flattens out the chart from what we are normally accustomed to, less than 500,000 jobless claims. That is massive. And when I've talked about this before, that what we're seeing here is a major problem because, if these people aren't working, poor countries, or when people are poorer, they have, more health problems, right? And one of the things we have to really start balancing here is if we become very poor as a nation, our health is going to start dwindling, and that really will exacerbate the whole problem with these viruses, right? With coronavirus, it is really attacking people that have pre-existing health issues. Those are the ones that are at major risk, and or the older people. But older people will have a higher tendency to have health problems as well. So where does it come in that we do have to start worrying about the economy? I'm not worried about the stock market. The stock market is just a reflection of how overall free market price discovery is taking into effect all of these things. So the stock market, when people are saying, everybody wants to go back to work to get the stock market going up. No, it is all about, yes, we are definitely looking at a recession, but if this goes on for much longer, you guys, it's bigger than that. It's a depression. Recessions are easy, quote unquote, in relative terms to a depression to get out of. We can see those cyclical cycles in recessions. We've talked about those. But people aren't really talking about this depression, which means, yes, the economy can start moving, but people aren't spending and people are afraid to spend. Well, that is what we could start seeing if people are afraid to go out to the malls or go out and start spending money at the movies and things of that nature. That becomes a depression, not a recession. Recession, you can spend your way out of it. A depression, you have to incentivize people massively in order to spend, and that's very difficult when people are afraid. All right, so anyway, that's my soapbox. But anyway, something to ponder going forward. Crude oil coming off by about $1. We're talking about lack of demand and massive increases in supply. That market is going to not see the 50s for quite some time. Gold futures up $18 on the day. One thing to note here, weakness in the dollar with this printing of money and the emergency economic stimulus package going through, all of those things, the Fed saying that they can print unlimited amounts of money should drive the dollar down. Of course, you know, it's a race to debase. All the other countries are going to do relatively the same thing, but that will drive gold higher. One thing, though, I would worry about right now as people that were fearful of getting into the market start seeing this rebound happen. I don't know that we're going to see a V-shaped recovery in the equities, but that would cause people to sell some of their gold to jump on board on this rally train. All right, bonds up about 0.5 point on the day. Nothing really to see here. Interest rates aren't going to go anywhere anytime soon. VIX is coming off. It lost the 60 handle, but still at massive elevated levels. This chart would look almost the same as what I showed you over there at the unemployment claims. Not quite as dramatic, but there's been a couple of spikes, but anything up in the 60s is just huge volatility. Still pricing in like 4 or 5% moves in the equities, which is what we're getting. So it's dead on. Here we have the Dow Jones Industrial Average futures. These are the futures. And they are up 5%, 5.5% on the day, up over 1,000 points. So making a move. We talked about this yesterday. We got the confirmation of a bullish move here. We're back above the 9-day simple moving average. Do I think we're getting that V shape straight up to here? I don't think so. I think we're going to see a little bit more of some bouncing going on. I think that we might see the market come up to about this level, maybe come back, and we're going to kind of see stuff like that going on. I don't think that we're going to see this straight up. I think that that's a bit out of the question, but right now we are seeing that confirmation of a move to the upside. A lot of bullish signs out there. NASDAQ up 275 points on the day. As you can see, it looks like it's having trouble getting above this 77.65 area, which is where my Fibonacci's are lined up. And I've talked about this. I kind of see us bouncing, getting this recovery, maybe bouncing in and around here for a little while, kind of like that type of pattern. I don't know that we're really going to see that immediate move to the upside in NASDAQ. I was going to draw a line there, but we'll maybe do that. I don't think we'll see that line in here to come straight back up. I think that that is pretty much out of the question. Oh, look at that. Something learned. I want to go forward. There we go. I think that move was out of the question. Why aren't you letting me do that? Anyway, go back. No, forward. There we go. I think that line, or this move that we talked about, is out of the question. Anyway, enough of that. Let's go back to the mini S&Ps. There we go. Here we go. Trial and error. Let's see. This move, I think, is going to be out of the question. There we go. Don't think that that's going to happen, but I do think that we would see this move up to here is out of the question, but something more along the lines of getting a bounce up in here and kind of doing that is more what we're probably going to see. All right. As the markets try to recover, but with 3 million people, you guys claiming unemployment right now, it is going to be, those are some jobs that we aren't going to see come back anytime soon. And we are going to have to deal with that we're going to have to pay the piper going forward. Here's the E-mini S&Ps overnight, basically making that move. Yesterday, we had the big sell-off after Bernie Sanders came out and said that, the stimulus package isn't going to work out, da-da-da-da-da. Well, I think it's through the House now and on to the Senate, so it looks like it's going to be maybe voted on either today or tomorrow to get pushed through. But that Bernie Sanders throwing the wet blanket on there caused the markets really to fall out of bed yesterday. Like, as we had a rip your face off rally, then that basically just was completely taken out in like a 30-minute candle. So it was just like a free fall after he was talking. So market's not liking Bernie Sanders talking, I guess. All right, let's talk about some trades that I've done. Coca-Cola, you guys remember I started getting into Coca-Cola a little bit earlier, talking about how I thought it was going to be able to sustain right around at this point of control. So we got the point of control right here. That's where I started getting into this trade and started selling puts. And it was probably pretty close to the highs, and I was selling the 53 puts. Well, that's where I'm basically long, the 53 puts minus 35 cents or something that I collected for that. But I thought we were going to be able to see Coca-Cola kind of hold on to this. But of course, we've got this big sell-off in there. And talking about dollar cost averaging, I'm still okay with having Coca-Cola in there, but I need to stay mechanical with this trade and continue to lower my cost basis on it. Sometimes, short calls or short puts is the way to do that. And I always talk about that. So what I had done when the market really sold off in and around, what was the date on this? The 23rd, which was not too long ago. So we can look at the 23rd, basically right in here. I got it on the day that it was on the lows. Better be lucky than good. And I went in and sold those April 30 puts in there for 73 cents. I was able to buy those back for 13 cents. So lowering my cost basis by 60 cents. If we see this roll over again towards those lows, I'm still in Coca-Cola. I'm going to continue to sell those 30 puts. I think that's a good location to be selling those puts given the opportunities out there. So, if I've gotten this bounce, the market rolls back over, I'll start adding some more to that position by selling the 30 puts in there. So that's what we're looking to do to continue to stay mechanical in here. And then we go over and check out the Micron technology. I've talked about this. People are going to be building out their home offices, especially being a service economy. A lot of those people can actually work from home. They don't have to go into the office. I think only 40% of corporations have work at home kind of policies. I think you're going to see that paradigm shift, at least flip to 60%, maybe even 75% of at least the service sector for sure, right? Manufacturing is going to be a completely different beast. But with Micron technology, people building out their home computers, whatever goes into that, they make chips. Therefore, I am going to look to add this if given the opportunity. And so I decided to go into the April, sold the 37 puts in there. I got the low tick of the day at 88 cents. I was a little bit late on that move, but at the point of control being 42, 43, the 37s, my 37 puts are down here. That's about the 37 puts. My break even on this trade is my break even, it is, why does it want to change? I don't understand. Anyway, my break even on that trade is just below $37. All right, so the break even is, minus that 88 cents. So 36.12 is my break even. All right. Just needs a little lighter touch, I guess. Anyway, that's all I got for you guys. Those are what the things that I'm looking at doing. Everything else is working pretty good. I threw out a video earlier today. Hey, I'm back in black. All right, so market's moving in my direction. All of these things that I've been doing and taking some heat on. I'm building out a portfolio like, a lot of you out there are trying to do. And yes, the one thing we used to say on the floor you know, you have to get run over to get filled. And sometimes that is what you have to do. And it feels like you're catching knives or whatever other phrase you want to use. But stay the course, stay mechanical, continue to do some of the things that I've talked about in your own way to be successful in these type of markets. There's opportunity abound, and I suggest checking out some of my webinars and implementing options into your portfolio. Keep in mind though, past performance of any trading system or methodology is not necessarily indicative of future results. We are an educational company. I'm not here to give you guys trade recommendations. That's not what I believe in doing. I don't like the herd mentality. I don't believe in it. I don't want you to lemming off the cliffs with me based on my assumption. Come up with your own assumption. But take these option strategies, look at the rules that I've come up with. It gives you strike location, days to expiration, the environments that you need to have in order to implement these into your portfolio. And then therefore, it leads you to the right strategy for your market assumption, okay? So make sure you check those out. That's all I got for you guys. We're doing another webinar today. So go to protraderstrategies.com, sign up for it so you can get it live. Live is a little bit more fun because it's interactive. I ask questions throughout. You guys drive the content in that for the most part. And it's always a lot of fun. All right. So if you can't take that, take it easy.